So I know there's a lot of confusion, particularly with first-time real estate investors or new real estate investors, into what all these different financial metrics that real estate investors use in order to determine if a property is a good deal or not. So for example, we're always talking about the 1% rule, cap rates, cash flow, and net taxable income, as well as net operating income. So in this video, I'm going to break out for you all those different terms, and we're going to use just this one financial statement to kind of break out all these different terms so that you can easily recreate it yourself. So if you're enjoying these series of videos, be sure to smash that like button, subscribe if you're not already subscribed, and share this video on social media because it's the only way people find my videos. But let's just get into it. That's enough about that. So this example here uses nice round numbers for simplicity's sake. We're assuming the purchase price or acquisition cost of $100,000 for this property. This is a monthly breakdown of the different financial metrics. So gross rents, that's just the rent you're collecting every month. Operating expenses, those are expenses related to the operations of your rental property. So in this case, we're assuming that we pay some or all of the utilities, $200, property taxes, $100, maintenance, $100, for operating income of $600. Then we have our mortgage payment, and remember, your mortgage payment often includes a principal and interest part. So in this case, we're just assuming this $400 a month payment is $200 interest, $200 principal. So our cash flow is $200 a month. Then we're going to add back our principal for $200 a month, subtract our amortization of $100 a month to get net taxable income of $300 a month. It's just that simple, guys. Now, I know a lot of you are probably a little confused, so let's dive into this just piece by piece by piece. So, in order to determine the 1% rule on this property, we're going to take the gross rents of $100 and divide it by a purchase price of $100,000. So you can see here when we take our $1,000 a month in gross rent divided by a purchase price of $100,000, we end up with a property that meets the 1% rule. The 1% rule is simply taking your gross rents per month and dividing it by your acquisition cost or your purchase price. And so the next financial metric we can take out here is our cap rate. And now our cap rate simply is trying to take a look at what our income is, what our operating income is, and this is ignoring anything like debt service costs or taxes or amortization or depreciation. And the idea here is you want a metric that makes it really easy to compare one rental property to the next rental property. We're trying to boil things down to apples comparison. What's also nice is it doesn't take into consideration different financing techniques you could use on a property. The different ways you can play around with the financing on a property can drastically impact the cash flow as well as the net income. And so that's why a lot of people like cap rate, is because it's an apple to apples comparison that ignores the different types of financing situations you could concoct in order to make this property work. So in order to determine the cap rate, we're going to take our $600 a month operating income, times it by 12 in order to get our yearly operating income, which is $7,200, divided by our purchase price of $100,000, and that's going to give us a 7.2 cap rate. Now, in order to determine our cash flow, we need to take our operating income and subtract our mortgage payment, because we have to pay our mortgage in cash every single month. That's a cash outflow from us. So in this case, our monthly cash flow is going to be $200 a month. So in this case, our cash flow is $200 a month because we have to subtract our mortgage payment of $400 a month. So we now have our cash flow of $200 a month. But if we want to determine what our net taxable income is, we're going to need to add back our principal, because our principal in this case isn't a taxable event. Our principal is simply repaying the debt portion of our mortgage. It has nothing to do with any expenses. It's only the interest that's an expense. The debt repayment is really just like moving money from one pocket to the other. You're saying, I have $200 cash and $200 loan. Instead of having a $200 loan and $200 cash, I'm just going to merge them together and have zero cash and zero loan. In order to determine our net taxable income, we need to add back this principal amount. So that's what's going on right here. We're adding back the principal portion of our mortgage payment. But for taxes, we can subtract amortization expense or depreciation. And so simply what that is, that's allowing us to take a part of the asset base, the asset cost, this $100,000, and it's allowing us to expense or depreciate that asset. We're recognizing the fact that that asset's depreciating in value because its useful life is deteriorating. So again, just for simplicity's sake, in this case, I said let's assume our amortization is $100 a month. So we take our cash flow of $200 a month, add back our principal of $200 a month, subtract our amortization of $100 a month to get our net taxable income of $300 a month. So you may be wondering about this amortization thing. Where does it come from? Well, the amortization is going to be based upon whatever your exact tax rules are. So in Canada, a lot of single family homes or a lot of small rental properties, you're probably going to be able to amortize 4% of the property cost. However, that property cost is really just going to include the building value. So you have to subtract the land value. And now, I know this is probably going really fast for those of you that aren't familiar with finances, that aren't familiar with kind of doing an income statement or a cash flow statement or determining cap rates, the 1% rule. But when you actually take this step by step, it's a pretty simple process. Again, we have our gross rent, so that's just the rent we're collecting every single month. We're subtracting our operating expenses. Those are any expenses that we need to incur in order to operate the property. So as well, if you had management expenses or like furnace rental, water heater rental, those sort of expenses would be included here. Then we have our operating income, and we need to take our operating income and times it by 12 and then divide by our purchase price in order to determine our cap rate. But if we want to determine our cash flow instead, we take our operating income and subtract our mortgage payment. And now from that mortgage payment, it includes interest and principal. But for cash flow, both of those are cash outflows. It's reducing our cash reserves. So we're left with now cash flow of $200 a month. But if we want to figure out what our net taxable income is, the income we're going to pay taxes on, we're going to pay taxes to the government from, we're going to need to add back our principal amount of $200 a month. But because in taxes we can depreciate the value of this asset by, again, whatever the exact rules are in your tax jurisdiction. In this case, we're going to assume $100 a month, so we end up with net taxable income of $300 a month. So this is what you're actually going to pay taxes on to the CRA or the IRS. So if you're in a 10% tax bracket, that means you're going to pay $30 a month in taxes because we're making $300 a month in income. Net taxable income, that is. So yeah, that's a really high level explanation and breakdown of kind of how you can go about determining what the 1% rule is, what your cap rate is, what your cash flow is, and what your net taxable income is, all from just one statement. So all you need here is your gross rents, your operating expenses, know what your mortgage payment is, as well as being able to break out what the principal and interest portion is, as well as knowing what your amortization is. Once you have those factors, you can break out all these different metrics, and then you can start really comparing properties to apples. And ideally what you're going to do is you're going to compare all four of these different metrics when you're looking at a property to invest in. So this video is mainly concerned about the cap rate. So why do people care about the cap rate? Well, the first reason people really like using the cap rate is it ignores the debt servicing costs on this investment property. And the reason that's important is different people and different borrowers will be able to get different terms and be able to structure the deal differently. And that can really convolute the thing where you get caught up in trying to figure out, oh, like maybe if I tweak the mortgage payment or if I tweak the interest rate or if I do this, that, or the other, then it'll become a good deal. Then it'll start fitting my metric. The cap rate is a great way to keep yourself from playing those games with yourself because it can be really easy to fall down that rabbit hole and get lost in the if, ands, or buts when trying to determine if an investment property is a good deal or not. So the cap rate is a great way to keep yourself honest. Another reason that people like cap rates are, honestly, they're a relatively fast and easy way to determine the value of a property. And at the end of the day, with investment properties, we're always needing rules of thumbs in order to determine whether a property is a good deal or not, or whether we should dive deeper into the meat of the bones. And so remember, cap rate is actually a pretty simple formula. Cap rate is simply the net yearly operating income divided by the value. So in this case, our net operating income is $600 a month times 12 to get to a yearly operating income of $7,200 divided by our value. So in this case, we're saying we purchased it for $100,000, so that's the value of the property. So again, in this example, our cap rate is $7,200 divided our purchase value of $100,000 gives us a 7.2 cap rate. So what's great about this is, let's say this was simply a small duplex property. If we were looking at a much larger sixplex property, people could get lost if they're just focusing on the total operating income. The sixplex is likely going to have a much higher operating income versus the duplex. However, by using and breaking down the cap rate, it gives us a nice comparison for a more apples to apples approach. So what are some problems with the cap rate? Well, some problems with cap rate are that people can play around with their operating expenses still. So people could ignore things like repairs and maintenance or property management fees. As well, they may try and play down the utilities, property taxes, or maintenance. So you gotta be careful and make sure that these numbers are accurate. In addition to that, people will sometimes try and play around with the gross rents. So maybe the gross rents are $1,000 a month, But if they're not actually collecting that, if there is a bad debt or a vacancy expense, you need to factor that into these calculations as well to get a more accurate cap rate. And that's where some confusion can happen. Again, some people argue you should use actual vacancy. Some people argue you should use a vacancy rate. Some people argue you should use a blend of the two. And again, you just need to make sure you're using apples to apples comparison. So if your cap rates are including a vacancy percentage, just make sure you use that every single time you calculate the cap rate. If your cap rate's using actual vacancy, just make sure you use that every single time. But when you're using actual vacancy, you gotta be careful because some landlords or some sellers will try and play around with it and they'll lie to you and pretend that they're collecting 100% of the rent when really they have problem tenants and they're not actually able to collect those rents. So that can be definitely a huge pitfall that a lot of first-time investors fall into. So make sure you're aware of that and you keep from falling victim to it. And so at the end of the day, if you want a simple explanation for what cap rate is, think of it as the return on investment if you had no debt, if you had no financing on the property whatsoever, and were incurring no financing costs on the property. And so in summary, what are some of the major problems with only using cap rate? And so part of the problem if you're only using cap rate is you're not taking into consideration the age of the property or deferred maintenance. So maybe the reason you're able to buy that property for $100,000 is it needs $50,000 in renovations just to keep it standing. In that case, your acquisition cost or your purchase price should really be bumped up by another $50,000 to make it accurate. Because simply because you're buying that property super cheap because it needs a ton of work isn't giving you a realistic cap rate because it needs a ton of investment in order to continue producing the operating income that it currently is. Secondly, it's not taking into consideration the quality of tenants. So maybe the reason it's such a high cap rate is because you got terrible tenants and you need to babysit them all the time. And they're constantly causing problems and friction and trouble and drama and all that bullshit. And you don't really want to be taking that on. Another huge problem with cap rate is it's not taking into consideration the potential of the property. So maybe the property is severely under rented. Maybe you could increase those gross rents by 100%. In that case, your cap rate would significantly change. So you need to be aware of the potential of the property. So what often a lot of investors will do is a current cap rate as well as a potential cap rate where they're factoring in the different efficiencies and changes they'd make to the property, as well as for factoring in the amount of cost they're going to incur in order to get the property to meet that potential. As well, another problem with cap rate is it's not taking into consideration the neighborhood or the city fundamentals. So is this property in the Rust Belt where that city's maybe contracting and the current returns are unlikely to continue in the future? Or is it in a city that's booming right now where rents are on the rise, where realistically in a few years you expect that you'll be able to earn a lot more operating income, which will drastically change the valuation of your cap rate? Or maybe the property is significantly increasing in value, and so you need to be adjusting your cap rate for that increase in value. Meanwhile, your rents are staying stagnant. So yeah, that's it for this video, guys. Hopefully you now have a better understanding of the different financial metrics a lot of us real estate investors use. Hopefully you have a better understanding of what cap rate is, what the 1% rule is, what cash flow is, what operating income is, and what net taxable income is as well. And if you do, make sure you smash that like button and share this video on social media. Honestly, sharing is caring. It's the only way I find new viewers. So if you got value from this video, please jump on Facebook or Reddit and just share this video or your favorite video of mine. I'd really love to get to 5,000 subscribers before the end of the year. I'm only going to do it if you guys share this on social media. Anyways, thanks for taking the time to watch. Until next time, I'm Matt McKeever. Remember, making money is a team sport. There's more than enough money out there for us to all make it, but if you're not saving it, I mean, like, what's the point? Thanks, guys. Bye!